Good morning, everybody. Welcome to the Flow Show. Nothing like a geopolitical blow up on a Friday to deal with when you sit down at your desk. And Friday the 13th of all days. The stars are aligning, Kay. Morning, mate.
Morning, Ryan. Morning, everybody. Yep. Well, depending on how we look at it, for some, Friday the 13th is a lucky day. There's over 200 million to win on the Euro Million. So let's keep the hope.
Yeah, exactly. If I win it, I'm buying that island in Scotland that I put in the chat room earlier.
Yeah.
And
Can I stay for freedom?
yeah, we'll have to make sure we've got some internet over there, or not. It might be better not to have any internet on there.
Exactly.
We'll build a golf course. Right. Oh, let's get stuck into it. Obviously, lots to talk about. Starting with the Bank of Japan and a Bloomberg weak sources thing piece out, saying that the BOJ is seeing stronger inflation, which means they're going to likely hold rates next week, but then they could look to hike once the trade outlook clears. They see prices rising stronger than they expected earlier in the year. But as I say, they're going to be held back by these trade tensions. But if those are cleared, then they might go on and hike. The Finance Ministry is apparently going to hold another bond market meeting with players on June 20th, which is significant because that's after the Bank of Japan meeting next week. Which could infer that maybe they are looking to have a little tinker with some parts and then they'll see a reaction. But I don't know. Okay, it's a bit strange having it like a day after the meeting. Surely if they want to see the reaction, they need to give it a bit longer than 24 hours.
Oh, it all depends what they will do, right? Yeah, I think. Well, I mean, there was no use to do another one before the Bank of Japan, but it does leave the door open for them tweaking a little bit with their bond buying, with the tapering, with the maturities potentially. Or they may just leave a line in the statement saying that they are stressing a bit more that they are ready to buy unscheduled bonds and then have the meeting afterwards. It is so that it's quite rapid. It's quite rapid after the meeting. Let me just get that. So the 20th is already on the Friday. Yeah, they could have let the another few days go by, but perhaps they want to also send a message to the market that they are on the ball and they don't let their guard down right now, and that's the reason why they are doing it relatively quickly afterwards. They will also have material coming out of the G7, perhaps on trade. So why wait longer? It could be the other side of the middle, yeah.
Yeah, that's true as well. And on that front, Mr. Ishiba is apparently going to hold a telephone conversation today with Mr. Trump. Not sure why that's happening because we had earlier stories that he was going to actually meet Trump at the G7 this weekend on the sidelines. So, maybe he needs to book a table somewhere and needs to know when Trump's free. Who knows? But there's potential for some trade headlines, not just Japan, but elsewhere coming at this G7 shindig. It seems everyone, not just the G7 members, are being invited by Canada. So there's going to be loads of other countries there as well. It's been reported that the upper house election in Japan is going to be held on the 20th of July. And despite PM Ishiba denying this earlier in the week, another headline or story from Yomiuri is saying that the LDP is considering a 40,000 yen cash handout. So we don't know what's going on ahead of this election. Yes, mate?
My son will be happy.
Yeah, if he gets it. Well, Ishiba's denied it that they're going to do cash handouts, but who knows? It's election time. The sweeteners will be coming, no doubt. So yeah, that's going to happen 20th of July for that upper house election. Europe is giving us all the market good reason why the euro is up at 116, or has been up at 116. We've had industrial production out this morning, which came in at a healthy minus 2.4% on the month. So again, people aren't rushing into the Eurozone and into the euro because the economy is doing well. It's purely a risk move going on there, but we'll talk about that in more detail. We remain on ECB holiday watch, seeing who's booking their jollies. Schnabel's look like she's getting ready to pack a case. His monetary policy is in a good place now. The ECB can tolerate small deviations from its 2% target. ECB's Muller says inflation is likely to stay around 2% in the near future. Says he's heard Santorini is a nice place this time of year. ECB's de Guindos, not yet given his holiday plans, probably won't do so till Lagarde's made a booking. So the ECB concern has shifted from inflation to slow growth, which is actually a pretty important comment, because if they're happy with where inflation's at, the only reason to then move rates is if the economy isn't playing ball and picking up. So
he listened to the flow show yesterday.
Sorry, mate?
He listened to the flow show yesterday, that's for sure.
Yeah, exactly. They're all listening. They're all listening in. I'll have to start giving them holiday tips. But a important comment, I feel.
Very.
There. Yeah, go on, mate.
Yeah, very important, because that is what we were saying yesterday. I was saying yesterday, the untold part of the mandate, and now he's bringing it kind of officially to the fore.
Yeah, exactly. And that, as I say, that could be why we see another round of rate cuts. And if the economy is weak, as I keep remarking, if the economy is weak, it does lead to price cutting, like we're seeing in France, to try and capture business, which then puts you into potentially a deflationary mode. And then that's what the ECB will be picking up on. So it's very important that we continue to watch the data and don't get sucked into the everything is awesome by the ECB regarding inflation. Speaking of inflation, we had PPI data out from the US yesterday, coming hot after the CPI data on Wednesday, and it pretty much followed the same vein as the CPI data. No real change to the headline year-on-year numbers. PPI coming in as expected, 2.6%, which was higher than last month. The core, that did lose 2 pips, but only via it was revised up the prior month. So the core was down a little bit, still running at 3%, pretty hot. The monthly numbers, though, again, as I say, coming in 0.1%, 0.1%, pretty much the same as what happened in the CPI data. So a bit of a mirror image there, and a bit of a similar reaction in what we saw in markets. We also had jobless claims, which, as I mentioned yesterday, if they were ticking up again, the market's likely to hit that, even if it doesn't mean a lot. We got a 248, and we got continuing claims just creeping up to 1.956 million. Again, market saying, oh, here we go. This is it. But let's just give you a little bit of, let's look at the 4-week average just to show you what it means in the longer picture. Not a lot. Okay, so all of these little gyrations between 220, 250, they don't really mean anything. If we're chucking up 300 plus, 400 plus, then that's something. If continued claims is trucking up to 2.5 million, then we've got something. But these small gyrations, they don't mean anything right now. Although we have potentially got just a bit of a trend going on, a little trend. But as you can see, it's very, very slow, very small steps. One to keep an eye on anyway, but the market's still happy to smack the dollar any sniff of bad news. We're fully pricing into Fed rate cuts, or the market is fully pricing to Fed rate cuts. September is an 80% chance of a cut, with a follow-up cut as soon as October, whereas previously it was September and December. It's now September and October. So the pressure's mounting on the Fed. Speaking of the Fed, Mr. Trump says he will not fire Fed Chair Powell, which is pretty blatantly obvious by now because his term's coming up soon. Anyway, said he told Powell to raise rates if there is inflation in 1 year. But he also told Powell no need to keep interest rates this high, saying that he may have to force something. Don't know what he's going to force, but that's the threat anyway. He also said that auto tariffs may go up in a not too distant future. Kay, what ability has he got to force anything in terms of rates?
Nothing. Although it is not, and I had been reading up the first time he was talking about that, and in theory, but somewhere in theory, there is one way apparently that he could get rid of power, but then it becomes like a huge political game because the Fed has well a lot of things are set in law, but apparently there is one way he could potentially do it. But I don't know. What he could do now is use Besant to put max pressure on Powell. I think that would be the only or the most um, direct way to get the treasurer to put a lot of pressure on Powell. But still, I mean, okay, Besant used to be a trader, now he's treasurer, but will he go as far as putting that max pressure on Powell? He has said a few things, but not like as in picking up the phone and going like I had a meeting with Jerome Powell, but I honestly I don't think that Besant would go as far, even if pressured by Trump, which it's already in the possibilities that he's done so. Trump would have spoken to Besant saying like, "Come on, I mean, push Powell to do stuff because it's for our best and to lower the borrowing costs." But I don't think Besant would go as far as going any, for sure, not any legal way or so to put pressure on the Federal Reserve. So no, I think we're in, yeah, just truth. What is it?
Truth bombs.
Truth bombs coming out, and that's it. I reckon for now.
Yeah, it was a bit of a loose one. Him telling Powell to raise rates if there's inflation in 1 year. Powell's
That's
turns up in May, so he ain't going to be there in a year to raise rates.
that must be his Diet Coke who didn't go down well because he's constantly screaming for rate cuts. Why would he go with a rate hike?
Yeah, exactly. And well, he's showing he's balanced, I suppose. But as we've been mentioning on the show as well, we're likely to have the nominees being put forward for the next Fed chair well before the end of the year, which might make Powell redundant anyway. So, yeah.
Was it
Anyway,
Waller? Was it Waller who was trying to send winks to Trump and Besant? Was it Waller?
I can't remember. What, trying to throw his hat in the ring? Don't know. We'll have to look it up.
Okay.
Right. Anyway, on to Mr. Besant. He says the EU has been very intractable in trade talks. So that might be the next big trade conversation that the market's going to pay attention to. The US saying that it's becoming hard work to get stuff done with the EU. We'll see whether they manage to get a can kick on the tariff deadline. Trump and the rest saying that they're prepared to kick deadlines if countries are negotiating in good faith. Whether that qualifies the euro or eurozone for that will remain to be seen, but it could be a little bit of a crunch point as we get to the next tariff deadline, which the market, as usual, is ignoring, but won't when we get to about a week, 5 days before. Then the market will start taking notice again if we have headlines ahead of that. Right, let's get into all this stuff going on. So Israel has attacked Iran, knocked out air defenses and attacking nuclear facilities and whatnot. This has all been building up all week. and now it's finally tipped over the edge. One of the reasons was the IAEA, which is the UN overwatchers, we can call them that. Yes, they declared Iran in breach of its non-proliferation obligations, meaning that they've been up to no good, which has pushed Israel over the edge and caused them to attack. Now, this has come amid all these ongoing negotiations that the US has been trying to push for. That was likely to try and get some sort of deal to keep Israel in check, but that hasn't worked. US officials apparently still intend, or going to try to hold talks this weekend with Iranian counterparts. Whether that's all going to go ahead or not, or whether the brick walls are going up, the defences are going up, remains to be seen. So market is obviously taken a little bit of a hit on risk. And this risk is dollar buying risk, as we can clearly see for most of the pairs you're looking at. Euro dollar well off from the 116 now, heading back towards the 115. Dollar yen, it did have a little yen bid initially, but that's all reversed around. So this risk off is buying dollars risk off. Okay, so you need to be aware of that. It's not wholly the usual stuff, buying yen, buying Swiss at the moment. So be careful of that. What does that mean for the overall picture? Okay, we've got all this stuff going on in the euro, the breaker 116, the breaker 115, all big moves. And now we get this risk stuff thrown at it. Does it mean we're done going up? What's going to happen the rest of the day? We're going to get a bit of a muddy picture now, because anyone who's been long this in this run up and this break now has a decision to make. Do they stay in for the reasons why it was rallying, or do they get out because of the risk change that's happened in markets? We could see a lot of squaring up. Okay, so even if we get a pullback in euro dollar, even it goes back under 115, if it's all Iran, Israel headline driven ahead of the weekend, that doesn't mean that we're over going up. All right, but we could get, as I say, a lot of squaring up, a lot of repositioning, so it could well come under here. Okay, techs are off the table a little bit today with all these headlines and these risk moves, and that will be the case going into the weekend, and then we're on headline watch over the weekend. So if things might have looked clearer yesterday, they look very muddy today. So don't be getting sucked into trades that you thought, oh, yo, yesterday I'm going to love a dip up to 115. You know, the picture's different today. The reasons why we're at 115 is different today. Hannah says the Sunday meeting is cancelled. Okay, thank you, Hannah. We'll keep an eye on that. Kay, what are you making of this? Just on a Friday, we get a nice old spanner thrown in the works.
Yeah, exactly. Well, I must. My reaction in the room this morning was like, give me 115 and I'll buy euro dollar again. But as you say, it's Friday. We are ahead of the weekend. This situation in the Middle East. Remember what we said and what's been said as well in markets, is that if it gets to Israel Iran, it might really be an incendiary picture, and we are there. And so, as a trader, I would kind of wait, and I guess I'm going to wait until the weekend is over. And on Monday, the markets will still be there. If it's all done and dusted, we have seen the sanguine nature of the markets every time we had war headlines. Go back to what happened at the start of Russia-Ukraine. It's been always afterwards the market came back to what it was doing originally. So I don't think it's the whole thing is over for euro dollar or for the dollar in general. Or my overall bias has not changed yet, because also of what I've been seeing over the past years is that once it's over, and then a good picture to look at will be oil, for instance. But then the market always comes back to what it was doing before, and I think we are in the same situation. But is this over? By no means, right? I mean, those guys, there haven't been any. Okay, I mean they've been throwing drones and stuff at each other, and Israel went in with the fighter jets, but yeah, they still have a lot of missiles both sides of that border, and it's not over. So we might have to wait until the weekend is over and then see clarity. But what is exactly I mean, what we've seen exactly in all those pictures. If you zoom out a little bit on that oil Rhine, which is um, try to go on the weekly even also or on the daily or on the weekly, and then we can see what happens since the start of 2022-ish, the start of Russia Ukraine. You know, you've got those huge spikes in oil, but each spike has been lower. And look at the spike that we had now, um, yeah, and I'll come to that, Hannah, what you just said. The Each spike has stopped a little under where the prior high was. Okay, now this is a new situation. We could go higher. We could go up to 80 bucks, 80, 82 bucks, if the situation still sours over the weekend. But then after a while, the market comes back to, once this will be over, the supply in oil is still there, and the summer will be hot, so less, maybe less demand, and it's probably after a while going to calm down again. So that is what I mean. So the global situation for markets, for where money moves to, and especially for our audience, but because our audience is for a big percentage made of retail traders or at least short-term traders. Um, Usually big money goes back to what it was doing before because there is so much money in the system that it needs to be allocated, and models will take into account what is happening now. That's why we see those blips. They will stop doing what they are doing, then they will reassess the situation. But if the indications or if the indicators come out of the red zone and back into orange and then maybe even back into green, the market, the big money will still be continuing to do what it does, but it may be on pause right now. And Hannah, why you say that risk is not getting hit more? It's right because of that. Because the market is now, yes, you have this big spike in oil, you have that lower yen pairs, you have the lower Swiss pairs. That is the reflection of, but again, the market has been seeing that so many times already that it's the money says like, okay, we have seen this, but is this a reason to completely reverse everything that we are doing? No, we need to wait, right? We need to wait. And that is why risk is not yet completely falling out of bed.
Yeah, yeah, exactly that, mate. This isn't a new situation. It's been building pretty much all week, and you know, Israel going up against Iran and Iran going up against Israel isn't new. You remember? I can't even remember when it was now. The last episode we had when they all decided to lob stuff at each other, all for show. You know, Israel knocking all the drones out of the air, and what drones hit didn't really hit big populated areas. They've done this before. The only thing that's different in this situation that maybe the market is a bit complacent with, if the market's thinking, oh, this is the same old thing again, Israel are going it alone. Okay, whether behind the scenes the US has said, okay, you know, have it your way, we don't know. But usually when these things happen, they do get clearance from the US and others that they are going to do this, like they were previously. This is a little bit different. They've been building up and building up and building up and saying, we're not going to wait for the okay. If we feel a need, we're going to do it. So they could be out on their own on this one, which does make the situation different. The reason they've gone in is because they see exponentially larger threat from Iran and what it's been doing, which means there's a risk that Iran does have bigger missiles or better capabilities to strike Israel. So it isn't a thing for show. They could do some real damage. And then the market will really sit up and take notice. But markets, I've seen it a lot on Twitter this morning, people being complacent. Oh, this will just blow over and we'll go back to normal in a few days. We may well do, but as traders, you just need to know the risk on either side. And there's potential risk that we don't.
Yeah, exactly. The risk is by no means gone. I mean, let's pray and hope that the worst doesn't happen, but they have nukes on both sides. Huh?
Yeah, as a trader, I would rather be overly cautious and nothing happen than complacent and get caught out when something does happen. So that's what I'm saying. Don't get sucked in. Don't think, oh, risk hasn't moved, I'm going to buy the dip all day long and put my feet up. Okay, because that might not necessarily be the case. Your trading risk is as much headline risk as it is market price risk. Okay, you've got to protect your accounts at all costs, particularly on a Friday the 13th, going into a weekend with so many big events going on. Right, so let's have a look around. So we've talked about euro dollar. If this was just a technical pullback or anything like that, the world and his mate are waiting for a 115 try to go and jump in, and they probably already have some of them. So levels wise, it's holding up, but you've got to be careful if things do change. It's not going to, another big headline, that level, that 115 isn't going to stand up to anything, and we could be down at 114 in a flash. So make sure you are protected with your trades, got your stops in play, and you're not putting too much risk on the table. Dollar yen, probably I'm not really going to look to trade it, but I'm going to be watching the range still. We've still got my zone up in the 145s, which we messed around in. We're in the ballpark, sitting right in the middle between there, 143s. Got the 142s below as well. Yesterday, technically, it worked well. We had the dip, got down to this 143.20s, which matched the trend line, and then we bounced from there. But then we got the headlines. Trend lines don't matter. We have a little blow through. It stops where it wants to stop, and then we get a bounce. Things have calmed down a little bit now. Maybe the lines get respected again on any down moves. We were holding below 144. We're now moving back above that. So for me, it can run around to its heart's content in the middle here. I'll pay attention if we hit some of these wider edges. I have had a little nibble in Aussie dollar, a little beer pips trade. We had a flush out, again, headline flush out. I mentioned yesterday in the on our dashboard, our updates, that obviously the 64.40, 45 level is going to be the biggie, but watch for protection coming in ahead of it. We've already had that around here previously. We got it again in this flush move. What that means is that anyone who's been buying below here, above here, on here, parking the bus. They don't want the price to get back down to this level and put them under pressure. So there's bids sitting around this 50s, 60s area to protect that. That's why you get these moves close, but no cigar to some of these levels. We're trying to hold this 80 level at the moment. That's why I've done a little, I've had a little, call it a scalp. Not knocked any off yet. But I'll see if this 80 level holds, if the news remains pretty calm. If that level reestablishes itself, then we might get a move back up to 65. Obviously, this area up here still remains the key level we've got to get through. And it's proving to be a very, very tough nut between that fib and the 35, 36 area. So again, we won't do it this side of the weekend, but I think maybe next week, I'll think about dropping some of those buy stops in to that. Dollar CAD, we've talked about dollar yen being back on the yield correlation. The loonie or Canadian dollar is back on the oil correlation, naturally, when we're getting some big moves. But technically, it's still doing all right. 136.15 was my level on the way down. It's the level on the way up. So technically, this is playing nicely. We got to pretty much the bottom of my zone before the bounce. We're now in this dip from that 136.50 trying to hold the top of the zone. So this is why I have these levels on here, and I don't move my levels around. They're on there and they stay on there because these are levels that I need to pay attention to because they've seen action time and time and time and time again. So does it mean we've bottomed? Not necessarily. We look like we might have been bottoming at 136.50, but we still broke that. We look like we might have been bottoming at 137.5. We broke that. So this trend has been going all year, and there's no reason to think it's over yet. But going to use my old line, the price action is going to tell you the story. If we start holding along here for any significant amount of time, then we're probably going to get that break up through 136.50, and maybe we see some semblance of a bottom going into play. We've had this low, we've had a step up from that low, okay, rather than a low, new low keeps the ball rolling. This might be changing something, but it's very short term. But as I said, you've got to keep an eye on oil. If all this stuff comes down, oil comes down $10, this will probably be going up to 137 again. So we're on the oil bus. Keep an eye on that as the main driver going on, because while the dollar's bid in a lot of other pairs like dollar yen, it's not that bid here in dollar CAD. So that gives you the story of what's moving this pair at the moment for as long as that lasts. Right, Kay, I'm going to ping it over to you for a few, mate.
Mm-hmm. Yeah.
If I can remember how to do it. There we go.
Okie dokie. Let's have a look on oil. Yeah, by the way, I'm still short dollar CAD. I think it's nothing's changed yet. Those levels there, we had that blip into the 137s the other day, got rejected. Pretty decent, I think, to just continue this thing. It was already coming down before oil also started to spike. So I think we're the picture hasn't changed. That's what we're talking about when the overall bias and also why I'm commenting on the fact that we have a lot of short-term traders in here, and they sometimes tend to forget what the what the overall bias is because you see a short-term move. Obviously, a lot of people and everybody does what everybody finds the most useful for them, of course. But to me, they're still very important to keep the overall bias just in mind and not always let the short-term stuff, even though today it's kind of a biggie, let the short-term stuff influence your overall bias. Okay, right. Gold, obviously, it's still one of those instruments which is the best hedge, or the hedge that the market wants to have on board when things don't go as planned, or when risk is getting hit, and we were banging our head a little bit against the resistance here yesterday, but then finally that Israel Iran thing made it fly through. We are trading not too far from that prior high here, but of course ahead of the weekend, I would suspect that people won't want to be short because, yeah, the worst could still be ahead of us, and so I think that if we would ever get a move back down, even 34 perhaps will be enough, but into that zone, 75, 85, 33, 75, 85, I trust we are going to find demand over the course of the day, and then on Monday we will see where we are. And don't forget that that was a big, kind of a big level, that 3.5 K on gold. If it goes through, we could easily, if you look at the longer term, we could easily knit on another 100, and why not $200, you know. Overall picture very much unchanged, and for as long as we remain above those bigger levels here, the global picture is still unchanged, even though we had built this pause in which reflects somewhere what we have been saying about the tariffs as well. that we want to see what's going to be the final outcome. And the gold market also went more into a range mode in the advent of more news on tariffs, which actually could be this weekend on the G7 as well. So we have a few things to wait for potential outcomes over the weekend. Obviously, Iran, Israel, and then the G7, which is ongoing. Silver is a little less obvious. We need to go on the very long term to see this break. Um, this break of 35 has been 35, 34.90, 35.15 has been significant, and since then we have not looked back on silver. Okay, so keep that in mind. This 35, 35.15. The day that we go back under there, I think we can see a bigger correction. But for as long as we're above this green line here, and we see those prior tops as well, this is an important zone. Okay, 34.90, 35.15. For as long as we're above, this thing is still quite big. We're turning around this 127.2 extension, but we are very, very close to that prior high here, 36.85. I think above there it's 38.5. And then on the downside, as I said, that well, it's 34.80, 34.90, but then you have to go on to the longer term to see how important that 35 is. Okay. What else are we looking at? Yeah, you always want to look at the cable, right, Bran? Um, break attempt, another attempt, but we stopped just around that top end trend line here in the cable. It is the gateway still to trade up into the 137s, but we need to respect it. All right, we need to respect that level 136, and now adding, of course, the 136 and a quarter on the cable. We really have to go above to get going again. Get above, I think we accelerate, and it could be the case next week. And if the market goes back onto doing what it did before this Iran Israel situation, it's still very possible that we go. And I would even say if you break back above 136, 10, 15, we are not going to stop at 136 and a quarter now, but the risk is that we straight going into the 137. In the meantime, where rejection we had, so we need to trade wedges, triangles, if you like. The 135.15 is going to be interesting, and then I would still door because this, I've been saying that many times now. When the trend line is too I mean, it's going up too fast. It's coming too fast to the market. It's maybe not your most important thing. Yeah, there may be a few stops if we break below, but I think the more important zones here for the sterling are lying below where we trade or where we traded on the first Israel impact. It's going to be coming in rather around 134.65 down to 134.45. I think that is really, if you want to look at the level that potentially could put the recent trend in danger, that's going to be the first barometer, in my opinion. That's the 134.45, 134.65. Okay, that's going to be more important. All right, in the short term, 135.15 on the downside. Euro sterling could potentially be interesting. Okay, as you saw this rally. It was kind of coming, as I said before, even before I left, but we stopped at the 38.2 here, which is also the 50% of that move. So 85.5, pretty decent level, all right. And now back already below this little trend line here, which is around give and take 85.20. So we have two levels here on the top side, 85.20, 85.5. If risk would start to do better again, that could be a reasonable top that we have in place here. Of course, if we break above 85.5, then I think we're pretty quickly going to change big figure again up into the 86s. But as we stand, it's been rejected, and we are now like in a bit of a traffic zone here that we had, and I would say 84.90, even down to 84.75. We still have to be vigilant because it can do this and then start again. But for now, it does look that potentially, on the cross side of things at least, the worst for the sterling may be kind of over. All right. Big big reignition of the downtrend, I would say, is if we get down below 84.45.50. If we get back down below there, then I think we are going to, this has just been a correction and we are going to go back down. Right. Unit, why are we trading like the event last night did not happen? Well, that is what we said just earlier. I don't know when you tuned in to the show, Unit, but we are not trading as if nothing as if nothing happened. But you can't do anything against market flows, right? Myself, I'm a little surprised when I look at US yields and risk, because it is a big risk event, that the dollar yen is actually coming back so easily. I'm somewhere a little surprised. But what can we do about money flows? About money flows, right? And also, what we were saying is that markets are sanguine, and they have seen these kind of moves already in the past, and those moves waving over. And once the weekend is done, we will see what happens. Perhaps it's just the people who have been selling risk that don't want to have it on the books either over the weekend, because we never know. It could all be over by the end of the weekend, which is okay. Israel has said that they could go on for weeks if needed, but who knows? Anything can happen in these markets. Um, what else do you guys want to look at? Because I'm not really looking at too many things. Oh, somebody asked about the Kiwi. To me, Kiwi and the Aussie are both in a similar kind of structure, and that is kind of a channel that has been building over the past month and a half, in Aussie even longer, over the past 2 months. A bit of a channel buildup. It is holding the levels. We have seen bids coming in the Kiwi around 60 already, but I would say like more rather look at those levels here, 59.80 down to 59.65.70. Those are more important for what's happening on the Kiwi. And it can't make up its mind. I mean, if you look at the longer term, 60, 40, 50 on the Kiwi, even if you go back even longer, I mean, it's always been pretty important, but it can't make up its mind. And it can't for sure right now hold it and build upon it. And I think that is what we need to look at for the upcoming sessions is, can we finally hold this 60, 40, 50 and build on it to go higher? Okay, because it's a relatively interesting level. So if we can't, it's possible that we go back down as well. They had the tendency of doing that move and then disappointing, and we've been talking about it, Ryan, as well, over the past weeks as well, right? That we had this commodity currency move, antipodeans move, and then they kind of fail us in a way, right?
Yeah, yeah, all the time.
Yeah, I mean it's really it's ridiculous, because you see this move is, to me, still should take the Aussie higher, but same as the Kiwi, they keep on having us guessing, right? And having us waiting for their move to really unfold. But
Which is
yeah,
that's good in one sense, because the longer it goes on like that, the more explosive the break should be.
yeah.
That's what it's like, a pressure cooker building up,
Mm,
and when it blows, it should blow quite dramatically.
yeah. Yeah, obviously, I think that, and we're always saying the next time, but indeed, it is a little bit like I showed in the Kiwi as well. You have a level above there, which is obviously that 65, 40, 50 or so. But I think next time we break above 65, figure 15, maybe really the one where it takes off, if the pressure is coming back onto the dollar, right? And that is, I'm still keeping this thing in mind. I don't have positions right now in the Aussie nor the Kiwi, but overall, it's still kind of my bias to try and catch a knife in them and see if we can go further. Really, I'm done for today. There's a lot of risk up and down everywhere. So be careful. We can see on any headline, we can see 50, 60, 100 points in anything. I'd say the one that I'm still kind of confident that we keep this break going. I know that Ryan has that 136.5 somewhere, but I'm looking at it slightly perhaps from a different angle. To me, for as long as we are below those 137s, it is still something that tells me that potentially we're going for a visit to lower levels. And with that, Ryan, back over to you, mate.
Thank you very much, mate. Good stuff as always, and welcome back. And thank you to all our viewers for coming and watching the Flow Show this week. Hope you've had a good week. Do remember that we talk about all this stuff in market terms, but all these wars and whatever do have a humane impact. We've got an old friend over in Iran, Kurosh, who used to be in my old chat room. Lovely fella, family man, trying to do the best for his kids, and I've pinged him a little message on LinkedIn. Hope he's all right. So there is an impact. So above all, stay safe this weekend. Watch out for those risk headlines, and have a great weekend. And we'll see you all on Monday.